Welcome to TradeTheNBI.com. This is John. This report is for the 14th, and you can see that continuation move from the white NBI lead has proved to be pretty solid. We're seeing the beginnings of turnaround here, though, with magenta moving back. So we may have seen enough of the basing move as it is now, and we've pretty much stabilized on the shakeout. We're at that key meeting point here. We have the crossover of the green. Unfortunately, no dip of orange going below, and that is going to make it difficult for any move at this particular point to be sustained. So we're likely to see some more back and forth before we get some gravitation to either push higher. We've filled positive extremes completely, so that's no longer a question. So that satisfies the algorithm setups from there. So the new move that is going to be created from it is really what we're seeing at this beginning base point right now. It's just going to be a little bit more challenging because we really don't have that impetus yet until we see that DOC green crossover the shorts, and they've already become weak, and that there really isn't a whole lot of extra short activity at this point. We can see that also from the NBI white. Never really had a strong spike of it to suggest that we would see much more of move lower. What we do know is that with rising 0%, usually there is a pull towards that 50%. And the fact that it's held up pretty well within that broad selling is pretty positive in general. And you can see from an NQ standpoint, there's been a lot more selling within the NQ, and a lot of it ends up being later in the day. So there's definitely some rotation taking place, and that there's a lot of movement out of the NQ, which has been an interesting one because you can see from its shakeout substantially weaker, and also now potentially a new dip below. The day hasn't ended yet, but could be dipping below the red line there, which would also express more weakness, and that's going to be a drag on the S&P. If their S&P has enough strength, it might be enough to hold it up, but that's been a drain that's been holding things down, and that's just because of some of the data coming out. Obviously, we've been talking about oil, we're talking about interest rates. Obviously, the bond market now has recognized what I've been saying for quite some time, since the last peak here in January, February, how ridiculous that move was. And we're now at really a parity of where things should be. So, and the potential for rate softening just doesn't exist now, and the bond market has finally recognized that the Fed isn't backing down from it, despite the fiscal calamity that it creates. Because when you look at deficit numbers, the interest payments, it's just staggering. We're getting into this exponential hyper debt that's just going to keep escalating at exponential levels, and how they get a grip on it, it's going to be a tough one, which is why you hear so much about the digital currencies and that, and the ability to reset, because then they can do all sorts of things. But oil maintaining its relative levels up here, and no end in sight for that, and particularly as long as there's conflict, i.e. through Russia, you have the bifurcation of oil trade and the amount of trade taking place in non-dollar, and that definitely going to have an impact. So you can see cyan under red DOC, so oil still within a buy configuration, even within this modest soft period. Not enough to really stave off future price increases that are going to be coming down the road. And the bond market is recognizing that. They're also realizing this from an EU standpoint, though still relatively overvalued here from a euro standpoint. It's going to take a lot of liquidity to keep things from degrading quickly. And of course, the Fed has been on it. I mean, despite all of the comments and attacks, they've survived this to this point so far with the manipulation of economies and things where everything has been going, at least with money supply. But there's going to come a point where it just becomes an unsustainable situation unless there's some kind of debt purge at some point, which that's an interesting one to talk about. So we'll see how that plays out. Gold, obviously necessary to keep that, because if gold were rising at the level represented by what we're seeing from oil, gold, and not gold, but just the economies, inflation is still a problem. Gold should be making its turnaround, but still, again, we've talked about this with derivatives and the paper trade in gold. You can really depress it, and it's still looking weak. So the potential for breaking that zero is uh, likely at this point. We have filled back from this positive extreme all the way. We did it once before, and this was only a beginning of the actual breakout. That is your potential low all the way down to the 1910 range. Crypto completely silent at this particular stage, even within the week readings in general. So it's held up quite well. We could see some softening below that, particularly we get that magenta below yellow readings, and with the DOC spread that started right here, the 50% is vulnerable to a break at this particular stage. And from an ETH standpoint, even more so, though you still have magenta riding above yellow at this particular stage. It's still facing potential break. And I think if you lose that 50% level, you're definitely looking at a move all the way to the 38%, if not worse. So from a 50K standpoint, you can see we came down, based a little bit. We had the spike, didn't quite make it down to the zero, got pretty darn close with the post-market dip that took us all the way down here, the 65 range, which was then about 6 points of that 0%, getting pretty close to the fill. And you can see we've had rising gold, which has been enough to keep this from really breaking down further. So that's been enough to hold it up intraday, but still getting pretty interesting sustained moves. We can look at it from Friday's action. Pre-market, yeah, the dip gets bought back up, fights back in between, held up fairly decent all the way into the end of the day. And then in post-market, boom, took the nice dip all the way back down to fill all the way back to where it was from the previous day's pre-market. So they're just clearing out stops, creating new runs, and then starting it all again right now with this huge pump up in the early morning there. That's all positive extremed from its original breakout right here. So your potential pushback down is to the 79 range, 10 points from where we are right now. And that's been the pattern for now. So, and the late day selling has been an interesting one as well. So we'll see if that pattern continues. And readings have been pretty spot on overall. So just keep following what is and go with it until we get some definitive read that things are going to break down versus maintain this sort of malaise that we're sitting in at this particular stage. So that will be the real interesting one to see if the Nasdaq is the one that's going to break the S&P down, or if the S&P is going to really be able to hold it up. The likelihood is that we just continue in this sustained soft drift lower at this particular stage until something significant indicator-wise from the economy gives us a clue that we're going to have more troubles. I mean, you can see a lot of worrying elements, but it hasn't been enough yet to really crack things up. So that's where we are. As always, though, I will update you on Skype chat. Trade well.